Hello, my name is Michael Glass, and I'm from eMediTradingCoach.com, and we want to go ahead and talk about our disclosures before we begin our video. Any symbols that we mentioned during our video should not be inferred as a trading recommendation. Any investing, stock, forex, futures has a level of risk associated with it. You have to determine whether or not that risk is suitable with who you are as a trader. Any back testing we do is just to show a particular strategy, and future results are not guaranteed. And any investment decision you make is solely your own responsibility. Trade at your own risk. So let's go ahead and take a look at our wrap up of the past week. This is our weekend wrap up for November 6, 2010. And so when we look back at some of the key events that happened the past week, we can see that our markets had a great week. One of the best weeks in a while. The Dow now year over year is up almost 10%. The S&P is almost over 10%, and our Nasdaq's up almost 14%. So if we were just looking at that fact, certainly you have a lot of reasons to be happy, bullish about the market. Of course, we know that there's other things going on in our world right now and our economy, but the stock market as a whole is doing good right now. Some of the key events last week, well, we can see that S&P rallied 4%. It was up every day in the past week. 10 out of 10 major sectors rose, with financials being the biggest at almost 7%. And on the corporate news side, we really didn't have a lot going on. The key factors of the week were more economic than corporate. Our third quarter earnings are winding down. On the economic news front, that widely anticipated FOMC announcement for Wednesday did happen. We're having a additional quantitative easing, QE2, $600 billion over the next 6 months or so. And they also left the interest rates unchanged. And, when it was released at 2:15 on Wednesday, the market kind of went up and down, and eventually did end up. And then Thursday, we had a great day. On Friday, we had non-farm payrolls announced, and there was an increase of 151,000. That's the largest since March of 2007. And private payrolls also gained, and they've gained 4 months in a row over about 100,000. So again, if you're just looking at the stock market, you have a lot of reason to be happy and cheering. Those people who sold at the March 2000 lows are probably kicking themselves because the market has come back pretty well since that time. However, again, we know that reality of what's going on in our economy does not have everybody in a good place. So when we go into next week, we can see that we have no earnings that's going to push the market one way or the other. And we really don't have anything on the economic calendar either. You might say something about Friday's Michigan sentiment, but in the end, we really don't have much going on this week. And we also have Veterans Day on Thursday. The market is open, but there's no economic events, no economic events on Monday. Mondays are what's going on overseas with Asia type news driving the market. But with no news, no earnings, it'll be interesting to see what the true sentiment of the market will be, what's going to push the market one way or the other. As far as technical analysis, what we're going to look at when we pull up the charts, our resistance. I have the April swing high still here. We are fractionally above it, so I feel like it's still acting as resistance. You might want to call it support, however you want to play it. Above here, you can say around 1300 would be our next target if we were to keep going higher and fully close above the April swing high. As far as support, the May 12th swing high is still there, and we've moved down. We were talking about the 200 simple moving average on the weekly chart as resistance, and now we're clearly above that, so it's now support. The 10 exponential moving average, and a point of interest is going to be around 1274, and I'll show you what I mean by that. I could have really done that instead of 1300, but I went with 1300 as our next resistance point, but our point of interest is definitely going to be 1274. So let's pull up the charts and take a look. Okay, so the first thing I basically want to show you is a really pulled back view that we can see where we are over the long term. We've got our low from March of 2009, and then we have our high of April of this year. And when we blow it up, you'll see that we are fractionally just above that. We are fractionally just above that. So if now that we're above this April swing high fractionally, where does that put us for the market? And you can see as we go back to 2008, and I know this is real small, and I'm going to blow it up in a second, but we haven't been here since uh, September of 2008. We haven't been in this area since September of 2008. And so I talked about a couple things about swing highs and points of interest. And again, I'm back here in of 2008. And this is where we are right now. And we're fractionally above this. And so you can see this kind of goes with that April swing high. That's where we are right now. And then I went right in here in this level here. This is at 1274 range where you can kind of see we did do a little bottoming here. We did do a little, resistance here as we went down. So that kind of interests me. But our clear top, our swing high top here from August, September of 2008 was at this 1300 range. So that's why I went with this as our clear resistance, but there is a little action going on here at this 1274 range. So let me just slide on over here to where we are now. And again, you can see we are just barely above this April swing high level and the level we talked about before. That's certainly good. Our indicators are once again back in the overbought range. We're back in the overbought range. You can see we even got the red on the RSI welder. So pullback certainly is in line. Again, the 10 exponential moving average as we went on up, acting as support. So that's good. Our indicators are overbought. We have potential support of the April swing high. And let's go ahead and switch over to the weekly chart. We've been talking about this for a month, and I'll blow it up here for you. And you can see this orange line here is the the 200 moving average on the weekly chart, and now we're clearly above it, so it should come in as support now on the weekly charts. Weekly charts are now basically overbought. Going and switching to the monthly chart. Again, we can see our clear lines. We are fractionally above it. Our monthly chart, which has been lagging, our daily has been overbought. Weekly is now getting overbought. Our monthly is now starting to get there. So, it's showing we have a little bit more room to go up. So our long-term frame is still bullish, but again, all three are starting to get aligned with over bullish. So a pullback certainly is in line. Moving on to our education portion of our video, we're using the book Trade Your Way to Financial Freedom by Dr. Van Tharp, and we're talking about expectancy. And understanding expectancy is basically saying that I know after I define my edge, I define my trading setup and level the playing field, that over time, out of 10 trades, it's going to be profitable. 7 will be profitable, 3 will lose. 6 will be profitable, 4 will lose. Over time, this trade taken equally, time after time again, will prove itself to be profitable. And in this passage, he's saying position sizing is just important to your expectancy, because if you put too much money into one trade and you're not able to take the trade the next time, then you're ruining the results. You've messed up the probabilities. So you have to make sure that you're putting the right amount of capital towards each trade so that you can let the results, let the system, let the trading setup pan out. Position sizing, risk management, all of that is just important as the entry. So when we talk about our resources, how you ever come to us at E-Mini Trading Coach, we're on YouTube, E-Mini Trading Coach on Facebook, we're E-Mini Trading Coach on Twitter, we're on E-Mini Coach. You can get our free videos, our free posts. We have a great 3-phase video curriculum for you. The first one's about the building blocks of trading, technical analysis, chart patterns, psychology of trading, risk management. We get into the second part of our video curriculum, and you can talk about the trading plan components, direction, location, triggers, and management. And then finally, we bring it all together, but once again addressing all the trading setups, how market internals affect that, and then the routines and habits of successful traders. And with all of that, we do throw in a coaching session as a bonus. You get all unlimited access to the videos, and we'll throw in a coaching session to answer the questions. But we do believe that coaching is what's going to take you to the next level. And if you think about a car, you can take it to Mako or wherever and get it to look so nice on the outside. But until you address the engine and the internal, all the outside is not going to make a difference. You're going to turn a car on and it won't start, or it won't steer. It looks good, but it won't steer. So you have to develop your inner trader. And we have various coaching patches from 1 session up to 4 months that will help you take your trading to the next level. We got a great relationship with Global Futures, 20 free contracts, intraday mini margin as low as $300. And Prepare to Trade, a great trading software. You got to work as hard at trading before and after the market closes as you do during the market close. In the end, you guys know our saying, it doesn't make a difference what you buy. A trading system, an indicator in a trading room, if you can't pull the trigger at the end, it all doesn't make a difference. And that's what we at Mini Trading Coach are about. Pulling, giving you the psychological capital to pull the trigger, define high probability trading setups, and be able to execute the trade. Thanks, guys, and I'll see you next time.